Welcome to Chapter 8. In the previous three chapters, we discussed different groups of current assets, and now we're going to focus on non-current assets, the ones we're going to use for more than a year or an operating cycle of the company, whichever one is longer, or the ones that we will convert into cash in more than a year. So they're called long-term assets or non-current assets. It's a large group of many different types of assets. This is an introductory course to financial accounting. So if you take upper level accounting classes such as intermediate accounting, you will actually probably spend at least 2 or 3 chapters on this group and cover it in more detail. We're just going to do the overview. So I went online and found financial statements for a couple of companies. So this is this is Tesla right here, and this is their balance sheet. And right here, guys, this is the group of current assets. We talked about cash, receivables, inventory, and now we're going to talk about all of this. This would be non-current. Anything after current assets, this is the group. And it's a quite diverse group. You can see here operating lease vehicles, solar energy systems, PPE. We will focus a lot on property, plant, and equipment. And it's reported at net, meaning at the book value, at the cost minus accumulated depreciation. Intangible assets, we will briefly talk about them in this chapter, goodwill, and so on and so far. So again, we're not going to go over every item. We will just cover 3 major components of long-term or non-current assets. Here is Coca-Cola and their balance sheet, and you can see here again, this is their current assets right here, and all of these are non-current assets. Again, the long-term investments, deferred income taxes, we're not income tax assets, we're not describing them. PPE at net, and you can see goodwill, trademarks, and franchise rights. So I'm going to cover this chapter in the same way your textbook talks about it. And the textbook divides all long-term assets into 2 groups. The first group is plant assets, or they could be called plant, property, and equipment. You saw that both Tesla and Coca-Cola had them, and it's usually a large group for manufacturers. These are your tangible or fixed assets, the ones we're going to depreciate. So we already talked about depreciation in chapter 3, but we're going to expand our discussion, and we're going to use 3 different methods of depreciation. We will talk about computing cost, depreciation, how to classify future additional expenditures, and how to journalize the disposal of those assets when we are ready to sell them or get rid of them. The second group is the natural resources. And again, if you think about oil fields or iron ore mine, for some businesses, this would be an important group. So I will very briefly describe natural resources. And the last group is a very large one, intangible assets, intangible long-term assets, such as copyrights and patents and leases and franchising rights. It's a large group, goodwill, but again, we will describe them quite briefly, and you focus on those. It's a gray area in financial accounting, and you study them in more detail in upper level courses. And we will conclude with one ratio called total asset turnover. Okay, let's dive into PPE. So plant assets, or PPE, this is their definition. They are physical or tangible in nature. They have to be used in operations. So if you have a building you purchased just for investment purposes, you're not producing anything in that building, it's just sitting there, it's not going to be classified as a plant asset. It would be classified as a long-term investment. So it has to be actively used in your operations, and it's going to benefit future periods. We're gonna use this long-term asset to generate revenue for many years. That's why we have to depreciate it. We have to spread its cost over the life of the asset to follow the matching principle. We have to match the expenses and the revenues it will generate per accounting period. These are groups of PPE. So you can see the only asset, long-term asset that is not depreciated is land. And the reason is because land can be used forever. It has indefinite life. But anything on land, such as your landscapes or fences or driveway, they're called land improvements, and they do have a limited useful life. So we will depreciate them, and we will call them separate. We will record them as a separate asset called land improvements. Buildings, machinery, equipment, furniture, fixtures, all of these are depreciated. We will debit depreciation expense and credit accumulated depreciation at the end of each period to record the expense that belongs to that period, to match that expense with the period and revenues it generated. For natural resources, instead of the word depreciation, we will use the word depletion. So it will be, the journal entry will be depletion expense debit, accumulated depletion credit. And for intangibles, some of them will not depreciate, the ones that have indefinite lives, the ones we can use forever. Because if you think about intangibles, since they're intangible, there's no physical substance, so they do not deteriorate physically like your buildings or furniture or machinery does. Some of them that do have definite lives, usually legally restricted, we will depreciate those. But instead of the word depreciation, we will use the word amortization. So amortization means the same thing as depreciation, but in regards to intangible long-term assets. So plant assets, right? So you buy a car, you use the car, you get rid of the car, you dispose the car. The asset value will decline over its useful life. So three ideas here, three problems. We have to decide, well, how much of the cost of that car do we have to journalize? Is it just the price of the car? What about additional expenditures? And also, what about future expenditures? What if we have to change oil? What if we have to change engine? What if we have to put new tires? Are those going to become expenses, meaning expensing them out completely in the period the expense incurred? Or are they going to add to the original cost of the car? So we're going to use the car, so we will have to, as I said, account for subsequent expenditures, and we also have to depreciate costs, allocate costs to periods benefited, which means depreciated. And then we have to journalize the disposal of that car when we're going to get rid of it, or we will be able to sell it, or we will be able to trade it in and buy a new car. So the first, again, idea is cost, compute cost determination. So besides the purchase price of the asset, we have to add to the acquisition cost all costs that are necessary to bring the asset to its intended use. Anything normal, reasonable, and necessary. So here's an example. If you buy this truck, besides the purchase price, its cost, so if I look at the amount of truck on the balance sheet, it will include also import duties, taxes, transportation charges, if I have to do the freight in to get the truck to my location, insurance while it was in transit, any kind of installation, assembling, and testing if needed. So anything normal, reasonable, necessary. Everything else, such as advertising expenses or any kind of repair expenses, they are not included in the cost of the asset. They will be expensed out right away. So let's take a look at this quick study, 8-1 on page 386 in your textbook. So here we are Kegler bowling, and we install the piece of equipment that keeps automatic scorekeeping, and it has a purchase price of $190,000. Do we include it in the cost of equipment, or do we expense it out? Well, the purchase price, of course, the $190,000, has to be included in the actual asset, right? It's a part of what we're going to debit as an asset, machinery, so it goes on the balance sheet. It's not an expense. Later, when we depreciate this equipment, this machinery, we will be expensing it out and moving it from the balance sheet to the income statement. The electrical work required for the installation costs of $20,000. Well, if I don't conduct this work, I cannot use this piece of machinery, so I include it. It's not an expense. It becomes a part of the asset. Delivery costs. I have to pay for delivery. If I have to pay, it's included in the cost of machinery. Sales tax, included in the cost of machinery. And then during the installation, a component of the equipment is carelessly left on a lane and hit by the automatic lane cleaning machine. So the cost of repairing is not a regular type of cost. So this one I have to exclude, and this one will be debited as a repair expense. So what is the total cost of machinery? Right here. $227,700. That will be my debit. That will be my base for calculating depreciation. Not just the original purchase price, but more components. Okay, so let's go to the next slide. So same with buildings. These are types of costs that I included in the cost of the building, not just the purchase price. And as I said, land does not depreciate, but any kind of structures on land, we will call them land improvements. Here are the examples, and we will depreciate them because they do deteriorate, so they have a limited useful life. But land, all of these costs will be included in the cost of land, but land is the only long-term asset that does not depreciate. Again, understand here that our book value of assets on the balance sheet, it has nothing to do with the market fair value. The actual fair value of land can go up and down significantly, but on my books it will remain the same. I do not adjust my long-term assets to the market value because it becomes subjective and impossible then to compare different companies against each other. Because appraisals are not auditable. They're not reliable for accounting. So, but we're going to record every single long-term asset based on its historical cost because it's an anchor type of invoice. We can look at the invoice. It's an auditable anchor type of cost amount that we spend. And it provides a better background for investors to compare different companies against each other. This is the next concept, and it's called lump sum purchases or basket purchases. Often, when you buy an asset, instead of making a separate purchase transaction for every asset, you buy a group of assets. Even when you and I buy a house, we buy a house, a building, but also land and also land improvements. So we buy a bunch of different long-term assets with one purchase. But we have to record them separately, right? If I buy land and I have a building on that piece of land and I have equipment installed in the building, I have to separate them. So I make one purchase, I pay $900,000, but I have to separate the three assets because land does not depreciate, but building and equipment do depreciate, but they will have different useful lives. So I have to separate them. So for the purpose of this separation of assets, I will use appraisals. So these appraisals, or estimated fair values, are not recorded in my records, but I use those appraisals to calculate the allocation percentage. What's the percentage of each asset in the relationship to its total appraisal? So look here, I actually spent only $900. But the appraisal appraises my assets at $1 million. I will not record $1 million, but I'm going to take each of these appraised values and I will divide them into $1 million. Again, I ignore 900,000 for now. I take appraisal values, 200, 700, 100, and I divide each one of them into $1 million, and it gives me the allocation percentage of each asset. So land represents 20% of the purchase price. So I take this allocation percentage and then multiply it to my purchase price. So out of $900,000, how much will be allocated to land? 180,000. That will be debit to land in my records. And I do the same for building. So I take 700K, divide by 1 million, 70%, apply it to my purchase price. So I will debit the building at 630,000. And I do the same for equipment. So these are the recorded amounts, right? So my total cash credit will be $900,000, but I will debit these three assets at these values. So I hope it makes sense. Let's practice one more time. A company makes a basket purchase of land, buildings, and equipment with these estimated fair values respectively. The purchase price is $210. By the way, again, if I add these appraisals, let me add it up. Let me go to the calculator. Oops. Okay, so 70,000 plus 150,000 plus 30,000 gives me 250,000. I did not pay 250, I paid 210, but I'm going to use this total appraised value to figure out the allocated percentage for each asset. So here the problem just asked me about land. How much should be recorded to the land account? So the value of land is $70,000 and the total appraisal is 250. So I'm going to take 70,000 and divide it into 250, which gives me my allocated percentage. So 28%, and then I apply it to purchase price of $210,000, and that will give me the answer. $58,800. That is my journal entry. This is the amount that I will record in the land account. So here is the answer, and again, here is the explanation that I walked you through. Okay, so we are done. Let me go back for a second. We are done with the issues of acquisition, computing cost when we acquire the asset. Let's now talk about using this asset. So we're moving into the concept of depreciation. And in chapter 3, we only use the simplest method called straight-line depreciation. I will go over it again. In addition to this depreciation method, we will use two more methods, UOP, or units of production, and DDB, or it's called actually double declining balance method, DDB, double declining balance method. There are many other depreciation methods. We're not covering them in this chapter, in this course. What I want to mention that GAAP doesn't care which depreciation method you use. All of them are acceptable. So this is a nice definition of depreciation. Since I purchased this asset and I will use it for many years, I cannot expense out my cost in 1 year because it will break the matching principle of GAAP. So I have to spread out the cost of the asset over its useful life. So depreciation is doing that. It's the process of spreading out, allocating the cost of the plant asset to expense in the accounting periods, benefiting from its use in the periods when that asset earns me revenue. So we have the acquisition cost on the balance sheet, and the amount of depreciation will be moved. Whatever we use up will go as a depreciation expense on the income statement and will be closed out, right? Anything from the income statement is closed out to zero after we prepare our financial statements. So here's an example. I buy an airplane, Boeing 737. I have to pay $32 million. It would be unfair for me to expense it today, this $32 million, because expenses must be matched with revenues that those expenditures help generate. So if I'm using this airplane for 20 years, I have to take $32 million and divide it over 20 years. So I will be expensing $9 million every year. That will be my depreciation expense, not 32 million in 1 year and then nothing in the consequent years. Okay, so factors in computing depreciation. We need to know three facts: cost, which is the true, real, auditable figure, and two estimates: the salvage value, which is an estimate, and the useful life, which is an estimate. Again, whenever you see estimates, if you're an auditor, you have to be very careful here, because if it's an estimate, companies have room to cook their books, to misrepresent information. So 3 depreciation methods. We will go over each one of them. These are data that I will be using in future screens. I am buying equipment that will be making shoes. The cost of equipment is $10,000. I will use it for 5 years. At the end of its life, its salvage value is, or residual value, sometimes it's called, is $1,000. So the difference between cost and salvage value is called the depreciable amount. So how much in total I will expense out? How much will I depreciate over the life of this asset? I will appreciate $9,000. A depreciable amount, a depreciable cost. And guys, I will need to know how many units I expect this piece of equipment to produce in 5 years. And my estimate is 36,000 shoes. I will need to know this number to figure out the second method of depreciation. Okay, straight line method, very easy. This is the formula. You should remember it from chapter 3. Cost minus salvage value divided by useful life. 9,000 divided by 5 years, $1,800. At the end of the year, that's my journal entry. This is the adjusting journal entry. Debit depreciation expense, credit accumulated depreciation for equipment or machinery. It will be repeated 5 times. So the straight line method is the easiest, and it's called straight line because you calculate your depreciation once and then you repeat the same adjustment. And after 5 years, how much is going to be left in the book value? I will depreciate it 5 times by $1,800. So after 5 years, 9,000 will be depreciated. So the book value of this machinery after 5 years has to be equal to its salvage value. So the depreciation expense will be the same every year, and the book value going to go down, 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 down. What is the book value? You have to remember the book value is the difference between the cost of the asset and its accumulated depreciation. Accumulated depreciation increases every year. After 1 year, it's 1,800. So after 2 years, it's 3,600. So it goes up and up and up. So AD goes up, the book value goes down. And this is where you can see it. You can see it on the balance sheet. So if I go back again to, Coca-Cola financial statement, when they say net, PP net, this amount, $10,838,000,000, is already the difference. That's the book value. It's the cost minus total accumulated depreciation. So straight line depreciation schedule, you can see every year my depreciation expense is the same. Depreciation rate, what is the rate? Depreciation rate is very simple. It's 100% divided by useful life. So how much do I depreciate every year? 20%. Again, remember this formula, we will need it later. Depreciation rate is 100% divided by by the useful life. So depreciation expense is the same. Accumulated depreciation goes up. At the end of the life, remember this, should make sense. Accumulated depreciation must be equal to depreciable amount. So at the end of life, accumulated depreciation is the same as depreciable amount or depreciable cost. And another check figure, the book value must be equal to salvage value. It cannot fall below it. So again, what's book value? It's your cost minus accumulated depreciation. it's your cost minus accumulated depreciation. It's your initial cost minus accumulated depreciation. At the end of life, it's your cost, 10,000 minus accumulated depreciation gives you the book value. The second method is called UOP, or the units of production method. This is probably the best method for matching expenses against revenues. So guys, look, there are two steps. The first step, look at the formula. The numerator is the same, cost minus salvage value, 10K minus 1K. But in the denominator, instead of dividing it by useful life, we divide it by how many shoes do we think we will produce. So it will give you depreciation per unit. Another way to think about it, when you drive your car for your company, they reimburse you so many, I don't remember now, 53, 54 cents per mile. So that would be depreciation per mile or per shoe or per unit. And then at the end of the period, you look at how many shoes did you actually produce or how many miles did you drive, and you multiply the number of units produced by that depreciation per unit, and that's your depreciation expense. So if, for example, some years, so if you look at straight line, it ignores how much we're using this asset. Some years we use it more, some years we use it less, some years we might not be using this asset. It sits idly. But we depreciate it no matter what. The units of production allows us to more specifically depreciate assets based on how many units they produce. The more they are used, the more revenue they generate, the more depreciation expense we are going to record. So here's an example. So we are going to produce, we thought we're going to produce 36,000 shoes. So in the first step, cost minus salvage value divided by number of shoes. So every time we produce a shoe, my machinery depreciates by 25 cents. This is an additional piece of information. So at the end of the first year, we totaled that we produced 7,000 shoes. So for the second step, you take 25 cents, multiply by the number of shoes produced. That's my depreciation expense. So when you use units of production, you have the actual units produced. You multiply them by that depreciation per unit. And your depreciation expense changes from a year to year, higher, lower. But look here, your total depreciation is the same as under the straight line method. It's just how you allocate it per year is different. And guys, at the end, total accumulated depreciation is the same as depreciable amount, and your book value cannot fall below the salvage value. Okay, let's take a look at quick studies 8-3 and 8-4. So quick study 8-3, straight line depreciation. On January 2nd, 2017, the Matthews Band acquired sound equipment for its concert performances at a cost of $65,800. The band estimates it will use this equipment for 4 years. They anticipate performing about 200 concerts. It estimates that after 4 years, it can sell this piece of equipment for $2,000, so that's the salvage value amount. And during 2017, the band performs 45 concerts. So in 8-3, we just need to calculate depreciation using the straight line method. So here I'm just going to choose numerator, which is going to be my cost. My cost minus salvage value. I choose denominator, which is going to be useful life in years. So cost is 65,800 minus salvage value 2,000. So my cost minus salvage value is $63,800, and the useful life is 4 years. So depreciation expense when I divide it is going to be 15,950. That's it, very simple. Now in quick study 8-4, we're going to use the same data, but now we're going to use units of production. So the formula for units of production is cost minus, the formula for the depreciation rate per unit, first step, is cost minus salvage value divided by total units of production. So depreciation per concert then, let me go right here. So I'm going to take cost 65,800 minus salvage value. We already calculated, it's $63,800, and we're going to divide it by the total number of concerts we anticipate. So depreciation per concert then is $319. This is depreciation per unit per concert. How many concerts did we perform in 2017? We performed 45 concerts, so we're gonna multiply it by 45 concerts. This is depreciation. Here it is, 14,355. Okay, let's move on. So the third method of depreciation is called DDB, double declining balance. And here we have 3 steps. So the first step is that straight line depreciation method we talked about. We already calculated it. So it's very simple, right? Take 100%, divide by useful life. It gives you depreciation rate or straight line depreciation rate. Then you double it. Guys, actually here you could say 1.5, 1.75, 2.5. We're using double declining method because we're going to double this rate. 2 multiplied by 20%, 40%. And step 3, all you're going to do, you're going to take beginning period book value. Guys, this is the only method where we are not subtracting salvage value. We're taking the beginning period book value. So in the beginning, I don't have any accumulated depreciation. My beginning book value in year 1 is its cost, which is $10,000. So this is the only method where you're not subtracting salvage value from cost. So the first year, my depreciation will be huge, $4,000. The argument here is that, when you're using your asset for a long time, it becomes old, it wears out, therefore you have to repair it more, and it generates you less revenue. So I want to depreciate much more in the earlier years, and in the later years, depreciation will go down. Now, the total depreciation, the total amount of depreciation will still be $9,000, but it's just I will depreciate a lot early on. So after the first year, how much book value is left? So in year 2, you have 10,000 minus 4,000, so you have 6,000 book value for the beginning of year 2. And you then apply 40% to $6,000, and that would be $2,400. So in year 2, your depreciation significantly goes down to $2,400, and so on so far. So $2,400, right? Next year, I had 10,000 minus 2,400, so my book value is 3,600 multiplied by 40%, so my depreciation is 1,440. What often happens with this method is that in later years, you sometimes will fall below $9,000. So you have to be careful. Sometimes in the last years, your depreciation will be 0. You have to watch right here because look, if I'm actually using 40%, then for year 5, the book value is 1,296. And if I apply 40%, then I should depreciate it by $518. But if I depreciate it by $518, my book value will fall below $1,000, right? So minus 1,296, my book value then will be 778. I cannot have it fall below salvage value. So you have to plug it in. In this last year, how did we calculate the last depreciation of 296? We simply took 1296, and I cannot fall below 1,000. I have to stop here. So my depreciation rate here is forced in, plugged in, $296. Okay, but the total is still $9,000. So let's take a look at quick study 8-6, page 387. Double declining balance method. So I have a fleet of refrigerated delivery trucks. I bought it for $830,000. The estimated useful life is 8 years, and the estimated salvage value is $75,000. So the beginning book value in the beginning first year, it's $830,000. The depreciation rate. So first of all, take 100% and divide it. Let me use the calculator. Okay, so I take 100%, I divide it by 8 years. This is my straight line depreciation, and then I double it. So what's my double depreciation rate? 25%. So I'm going to put 25%. Actually, it's not going to really change, so I will put 25% everywhere. So what's my depreciation expense? I'm taking 830,000, the beginning book value, which is the same as cost, and multiply it by 25%. That's my depreciation. $207,500. $207,500. That's the accumulated depreciation. What is the book value? Cost minus accumulated depreciation. $622,500. Second year, that becomes the beginning book value, and I multiply it by 25%, so I get the depreciation. Let me show you with the calculator. So 622,500 multiplied by 25% gives me the depreciation expense of 155,625. And again, oops, wrong, 155,625. Right here should be 20%, 25%. So you see how significantly the amount of depreciation expense goes down. What is accumulated depreciation? It's the previous year, it's the previous balance of accumulated depreciation plus the current depreciation expense. What's the book value? It's the beginning book value minus accumulated depreciation. So 466,875 multiplied by 25% gives me 116 and 749. Let me double check. So 466,875 multiplied by 25%. So 116, 7, I'm sorry, I made a mistake, 719, 116, 719 right here, and it gives me the accumulated depreciation and the book value. So we looked at 3 methods of depreciation. I do want you to pay attention right here. Guys, it doesn't matter which method I use. The total, the depreciable cost is the same. It's just how I allocated for every year is different. And guys, even though UOP is the best method for matching principal and DDB is probably the best method that encourages companies to buy more assets, straight line is used the most. You can see it's the most popular. And again, as I mentioned, all of these methods are acceptable by GAAP. Okay, I'm going to stop here and I will record the second part of the video with the rest of the chapter. Thank you.